What's going on, Bigger Pockets? It's Matt. So today we're going to talk about private money. And we're going to talk about the two different kinds of private money that you can get yourselves into and when to use them. So for the most part, now there's different derivations of the two. I'd love to argue with you guys on this one in the comments down below. But pretty much there's debt and equity when it comes to when it comes to private money from people, okay? Debt is when somebody loans you money. Equity is when they invest alongside you and take ownership, okay? That's a whole conversation, maybe a whole nother blog post aside from like how do you break down what these two really are and how they really get set up. But today we're going to talk about when the best time to use debt is and when the best time to use equity is. Okay, so let's break these two down. And I think that what you need to consider first. So the source for debt and the source for equity. Got it. Has certain benefits if they come from certain places, okay? So if someone approaches you with a self-directed IRA, you should tell them, hey, odds are, unless they want to, we have people that have self-directed IRAs that invest in apartment building with us and stuff like that invest their self-directed IRA as equity. But I recommend to people that they put their IRA source, if that's the source, that they put it in debt. Here's why, briefly. The interest that you pay somebody in debt, on a debt, the interest you pay them is 100% capital. It's 100% taxable. There's no write-offs they can take against it. If it's in an IRA, it's tax deferred, and they can take the interest that they make on that debt and reinvest it over and over and over, and their IRA money goes way, way up because they can compound the interest over and over again without having to pay Uncle Sam every time that you pay them interest. So self-directed IRAs are great for debt sources. Now, I have plenty of equity books because the reason why people would rather be over here is because of time, and we'll talk about that in a second. If people are loaning you money, or putting money into a deal, and the source is cash, okay, if they're putting cash out of their own bank accounts or something like that on the deal, you want to recommend equity because equity has certain write-offs that they get. The write-offs don't really materialize if you're doing it through a self-directed IRA. The write-offs that they get over here are things like depreciation, meaning if they own a part of the asset and you pay them X amount of dollars, they're not going to have to claim that entire amount that you paid them on their tax return because the building depreciates. There's write-offs associated with owning and holding real estate as an owner on the equity side, which do not show up through a self-directed IRA. But to a cash holder, they do. And a lot of people that invest with cash are looking for tax incentives and tax benefits for investing in real estate, which is why I think for equity, consider the source, and if it's cash, that works. Now, IRA stuff, now the reason why, let's talk about time, okay? Debt should be a short-term. If you're doing a short-term deal, then you should for equity for being a long-term deal. Okay. Now, looks like an S. There you go. For a short-term deal, I'm talking about like a fix and flip or a BRRRR or getting in, getting out. Short, I mean like 6 months to a year. That's when debt works the best because debt's expensive. For private debt, it is way more expensive than you're going to borrow money from a bank. You could be paying between 8 and 12% is what private money is going to cost you in today's day and age in debt. Now, that can change and all that, but just the reason why you want to go short term is because if you hold it much longer than 6 to 9 months, you should have been able to add value by then, and you can refinance that person out. You can sell the property, whatever it is, to capitalize on the value that you've created by renovating the property. So you buy it, you renovate it, you refinance it. You buy it, you renovate it, you sell it. This is a value add type of play. Okay? If you're doing big value add, like big value add, you should take on debt because you should be able to bring the building value up enough that you can refinance it to take this debt out and own it all free and clear yourself, or sell it and put that value in your pocket in cash, okay? So now, some self-directed IRA people will choose to do equity investments, and the reason for that is they want to be in something long-term. They don't want to deal with, there's a lot of paperwork associated with short-term stuff. They got to do loan docs back and forth. They've got to pass paperwork back and forth between you and them. It's a moderate amount of work, not a ton of work. It's worth the money that they can make, but Some self-directed IRA investors don't want to deal with that. They want to just put their money in something and have it produce quarterly checks back into their IRA. And if they're approaching or at retirement age, then this is okay too to do equity stuff, because they can, as the checks come in, they can take them and put them in their pocket. So it's not a hold it in the IRA and invest on top of itself and grow it long term. They're not in growth mode, they're in fixed income mode. So I know I'm maybe getting off topic a little bit, but still, self-directed IRAs self-directed IRAs are one of my favorite topics. So when I bring them up, I tend to go down that rabbit hole. So long-term stuff for equity, okay? The reason why equity deals are better long-term is because most likely an equity deal that you're going to do is going to be a buy something, maybe add value. We bought an apartment building recently, and we're going to buy it. We're adding a ton of value to it, and we're going to refinance it and give investors some of their money back. But it's still a long-term hold deal, right? It's something that that they're going to hold long-term, and it's not something that they need immediate checks on. This is like more patient, slow and wait kind of thing. Hold it over like a 5-year term or something like that. This is like 6 to 9 months. I'll write that down. And this is like 1 to 5 or more years. Okay. I'm on an apartment building deal right now that's 10 years. So long-term equity, short-term debt. Okay. Now, let's see, what else can we talk about here for debt versus equity? I tell you what, I'll leave it up to you guys. I think there's more to talk about here, but I'll let you guys throw some comments in the comment bar unless something comes up. One more thing. I'll throw this up here quick. Small deals, big deals. Okay. The reason for that is it's less risk for you to take a debt position from a private lender on a small deal, because the interest starts kicking in as soon as you buy the property, whereas for an equity deal, it might take a little while to get the property set up, to get it turned. Deals I've done didn't pay out in the first year, and the investors are okay with that because they want to be in for long term, right? They're not looking for checks immediately, where a debt provider is looking for a check as soon as they get into the deal. As soon as they close, they want to start getting checks. They want to have fixed income, they want it to be predictable, and that is a debt position, because debt interest is due right away, or it starts to accrue immediately as soon as you buy the property, right? So small deals make sense because you're not going to be subject to that much interest. Your risk profile is smaller, and you can probably get in, borrow a significant amount of money, and close on the deal. Whereas for equity, for bigger deals, it makes sense. Like I've done fix and flips. Like let's say if I'm buying a property that's somewhere between $50,000 to $150,000, I'll do that with debt. We're building 3 townhouses. So I've done fix and flips. I'm in the middle of some fix and flips on this side, and I'm just doing debt. I'm building 3 townhouses right now, and on that, I think I've done some videos on it. On that is a bigger deal. It's a way bigger investment, so that's an equity deal. That investor gets a small chunk, like a little bit of interest on their money, called a preferred return, and they get a chunk of profit too. The reason why you want to do these kinds of things, guys, is because if you do a huge deal and you borrow money at bigger percentages, right? Like 7, 8, 9, 10%, it can add up really, really quick. And yeah, you can still produce that kind of thing for investors, but you could end up sinking your deal if you commit to borrowing that kind of money on a big deal. You could end up putting yourself in a very bad position. I'd rather put my investors on the equity side, and yeah, they can have a big win, but the deal doesn't do as well, then I'm not subject to paying a huge interest payment and everything like that. It's maybe a hedge for myself, and I'm willing to give away some ownership in exchange for not having to guarantee a big check on the debt side. It's not flexible. The interest is what it is. Equity, they get a percent of ownership. So if it makes a ton of money, they get a ton of money. If it doesn't make as much money, they don't make as much. And I'm willing to hedge that and not have to commit to a big debt payment no matter what. Right? So again, there's more. There's more debt. There's more equity benefits one way or the other. I'd love to hear from you guys, so please leave it in the comment bar and we can chat more about it. So thanks for watching, guys. Have a great, profitable week.